Vice Premier Wu Yi and I see an important part of our job being to communicate frequently, iron out differences, and keep the economic relationship on an even keel, particularly during times of tension. Our first discussions in SED1 produced a number of agreements which marked progress on our strategic goals. Among the agreements was U.S. support for China's bid to become a member of the Inter-American Development Bank, a decision which recognizes China's status as an important voice on matters of international development. The Beijing meetings also helped to focus discussions around several key issues. The first is services, investment, and transparency. Structural reforms in both financial services and in non-financial services are very important to China, important to us in the U.S. as well. Now, I'm going to talk more about financial services later, but let me say one specific item on the agenda is an open skies agreement which would increase access to each other's markets in air cargo and air passenger travel. The second area is energy and the environment. Through the Strategic Economic Dialogue, we are collaborating on a series of issues from reducing tariffs and non-tariff barriers on environmental goods and services to improving energy efficiency and sharing technologies. After SED1, we announced that China will join the Government Steering Committee of the Future Gen Project, which is a public-private initiative to design coal-fueled power plants that produce zero carbon emissions. The third discussion area is innovation. Competition and investment create strong incentives for firms to increase productivity and provide the framework within which creative ideas can flourish. Producing, managing, and protecting intellectual property is central to this discussion. And finally, a major fact of our discussion is a need to rebalance domestic growth so that domestic consumption plays a larger role in investments and exports smaller roles in driving China's economic growth. This is a goal that the U.S. and China share. Now, I can't come to New York without talking about the importance of capital markets. Many years of hands-on experience working in the U.S. and in nations and markets around the world convinced me that competitive, world-class financial markets are the backbone of stable, balanced growth. And I've had a lot of personal experience, and I see John Mack here, and I know he's had a lot of personal experience too, working in capital markets in China, participating in bank reform, the recapitalization and privatization of some of the banks, participating in the development of the capital markets. And I would say that China has come a long way in developing their capital markets. There have been a lot of reforms, but the Chinese capital markets and the progress of the Chinese capital markets aren't up to the progress in other parts of the economy. And they're not reflective of or representative of the Chinese economy. And for this reason, I went to Shanghai on March 8th and delivered a speech on capital markets reform in China. Now, I had scheduled that and worked with the Chinese to schedule that months in advance. Now, it turns out I was there 10 days after we had the volatility and the downturn in the Chinese market and then a round of volatility around the world. And as I said, that wasn't the reason for my speech, but if it drew more attention to my speech, I would take it. But what I tried to do in my speech is to describe how well-developed financial markets can help China meet its goal of more balanced, harmonious, innovation-based, and environmentally sustainable growth, allowing China to continue growing at a healthy pace while spreading prosperity through the economy and giving citizens a better return on their savings and investments. And one example I used, which I'd seen on a first-hand basis in working with some of the banks in China, is there's roughly $2 trillion, and I gave the numbers there in renminbi, but it's here, I'll do it in dollars, roughly $2 trillion in bank accounts in China earning 2.5% interest rates. Well, after inflation and taxes, I doubt whether that's a positive real return. But the math is interesting, which is if that $2 trillion continues to compound to 2.5% over the next 30 years, that'll be worth $4 trillion. If, on the other hand, China and Chinese savers were to get something like an 8% return, which is in many industrial developed countries where where they invest their pension assets, they get it's not unheard of. As a matter of fact, it would be common to get an 8% return. And here, China, which is growing faster than the rest of the world, there's a bit of a paradox here that they're getting a 2.5% return on their savings. If they got an 8% return in 30 years, that $2 trillion, rather than being worth $4 trillion, will be $20 trillion, which is $16,000 for every man, woman, and child in China. Now, when you step back and when we look at the trade deficit, I talk about currency, which I'll get to in a minute. We talk about intellectual property. They're all important. But the biggest driver of the trade deficit are structural differences between our two economies. And the Chinese are saving at roughly a 50% rate. And you can see the reasons for the high precautionary savings when you're getting a 2.5% return on savings. And to me, one of the answers is to have competitive, well-developed capital markets and to have world-class asset managers come in and do business. I come from an industry, the financial services industry, investment banking, where I can look around and there are not many examples anywhere in the world of world-class institutions that are joint ventures. And that's not the way to run a business. And so again, opening up the competition, it can have a very big benefit for China. So as we talked about this, and I won't, this is a very long speech. I had explained to people, as I have a tendency when I write speeches myself for them to be too long. And then when I have my staff members say you've got to shorten them, I say, well, I come up with all kinds of excuses. And my excuse on this one was the Chinese like long speeches. Well, so much for that excuse. Because afterwards, as I talked to a number of people, they said, well, it was a very good speech, but we've passed it out, but we had to condense it because it was a little too long. So I won't take you through that, but I talked about the need to develop a domestic bond market and a yield curve. I talked about the need to develop a institutional market. They have an institutional market in China, but not one really as we know it. And you're always going to have a more speculative, volatile market. You'll have volatility in any capital market, but a more speculative, volatile market until you have a first-class institutional market. And I believe they need to take steps to develop that market, and part of which, again, is welcoming competition and foreigners who can bring world-class investment skills to China. And I talked about competition quite openly and said that the history around the world is that when you open up, employment to competition increases in a sector. And in financial services, if you open up to competition, the businesses will be staffed by Chinese, be regulated by Chinese, controlled by Chinese. They'll be world-class organizations, but they will look very much like every other Chinese organization, other than the fact that they will just perform better. But that the longer you wait, everyone welcomes competition in every area other than their own. And so the longer they wait, the more the domestic competitors will have a bigger vested interest, and it'll be more difficult to make change.